Well, hello, this is Eric Boyce, CEO and Chief Investment Officer for BK Wealth Consulting, and welcome to Market Minutes here for April 12th of 2021. I'm joined today with my esteemed colleague, Tom Kemler, who we have known. We've known each other for at least 17 years, probably even a little bit longer than that, but we're here to talk to you about the market and the economy, give you some news you can use, some things that we're seeing, observations that we have in the market. So this is really taking our broadcast to kind of a different level. So you're used to my market minutes, which is basically just me talking, but we thought it'd be interesting to kind of introduce Tom since he adds a perspective and maybe a different angle on things than I have, which I think is extremely helpful for all of you in the listening audience. But just to kind of get us kick-started here today, we might as well just go ahead and revisit the statistics from last week in the equity market. The Dow Jones was up 2%, the S&P 500 was up 2.7%, and the NASDAQ was up 3.1%. The S&P for the year to date is up about 9.9%, coming off plus 16% a year ago. The Dow Jones is up about 10.4% for the year. NASDAQ is up about 7.9%. And the Russell 2000 is up about 13.6% year to date after up 18.4% a year ago. Now, if you look at the international markets, Europe, the MSCI European index is up 6.5% year to date. So we've had fairly broad transmission of equity performance across most of the major sectors. Emerging markets that were up about 15, 16% a year ago were up about 3%. So they tend to lag. They're tending to lag a little bit, but overall, we've seen a fairly dramatic drop in volatility this year. Volatility, as defined by the Vix Index, is down about 26% for the year when it was up 65% last year amidst the pandemic. If you look at the bond market, we've clearly had a little bit of a retrenching in the bond market with higher interest rates. Barclays aggregate index is down about 2.9%, and it was up about 7.5% a year ago. High yield is actually having a good year. We've seen credit spreads tighten amidst the promise of an improving economy. So high yield index, the high yield index is up about 1.6% for the year. And if you go across to commodities, we've got WTI crude at just a shade under $60 a barrel. Crude is up about 22% year to date when it was down 20% a year ago. And gold, which I have actually some comments on gold, sits around 1743 dollars an ounce, which is down about 8% for the year. And gold, as we all know, was up about 24% a year ago. The US dollar, we've had obviously some gyrations in interest rates, and which has prompted a little bit of an increase in dollar, about 2.5% year to date, when dollar last year was down about 7%. So as a result, we see a 10-year Treasury about 1.66. It's kind of trading in a range right now. The 30-year Treasury is up about 2.3, and we've had a fair amount of steepening in the yield curve. The 10-year yield is up about 0.75% year to date, whereas we know that short-term interest rates are really anchored quite strongly to that zero bound for at least the time being. So again, S&P was at an new all-time high for the second straight week. We did have a stall and increase in yields, and we had a fairly strong period of yield increase, and that really just kind of stalled out a little bit here lately. And it kind of changed a little bit of market leadership. I know, Tom, you got some thoughts on maybe technology stocks. But small caps have kind of given up a little bit of their leadership over large caps over the past month. Treasuries, again, as we talked about, kind of that rise in interest rates has stalled out just a little bit. So we had a March 17th FOMC meeting, Federal Open Market Committee, that really reiterated that they still see the economy as far from its full employment mandate and well below its inflation goals, although inflation is picking up. And good news is that they haven't mentioned anything about tapering asset purchases, which, as we both know, created kind of a taper tantrum several years ago. But right now, this, I mean, is kind of shaping up almost to be, kind of a Goldilocks scenario where we have minimal inflation and reasonable growth, right? The commodities we talked about a little bit. Gold is, even though it's down for the year, it's off its recent lows. And then on the crude side, we've had conversation out of OPEC Plus that they're going to begin rolling back a little bit on production, and very cautiously in the coming months. So we hope that doesn't provide a lot of disruption in a crude in an energy market that is really trying to battle back here. I know you've got some thoughts on the economy. I'll just mention that last week we had the Institute for Supply Management non-manufacturing or services sentiment index, and that was an all-time high at 63.7. The job openings number rose to 7.4 million, which was it's above early 2020 levels, and producer prices, which we've been monitoring and we've talked about before, rose more than expected during March, and we're even up a fairly robust 0.7% when you take out food and energy. But Tom, you've got some other thoughts on the economy, don't you?
Yeah, I would say, just the nuance that we've seen just in the last week or two with some of the bond market retracement, as you put it. We took about, bond prices firmed up and pushed the 10-year down about 12 basis points or so, from around 1.77 to about 1.65 right now. And that's all that was needed to ignite kind of a major rally in growth. We'd been talking about how value had dominated the year at the expense of growth, because the growth stocks were much more, the rise in interest rates was seen as directly decreasing the multiples that you could afford to pay on growth stocks. And so, as interest rates crept up, we were seeing the NASDAQ was underperforming the value. But as soon as rates leveled off and went back a little bit, we saw those growth stocks. They just had a huge, really since the end of March, much more outperformance relative to value. So that's and then just to build on your comment about Goldilocks, I can't help but think, when they first came out with the term modern monetary theory a few years ago, and I asked, what is that? And I was just told, well, you can spend as much money as you want, and you can borrow as much as you need to, and don't have to worry about the consequences. I thought that was just ludicrous. But for all intents and purposes, that's what we're doing. Our government right now is performing modern monetary theory, and we've already spent, even inflation adjusted, more on COVID response than we did for World War II. Mm-hmm. Over 4 years, building ships and tanks and planes and adjusting for inflation. You can't help but think that there's going to be some sort of piper to pay for that. Right. But we're not seeing it yet, and that's the Goldilocks scenario that you were talking about. In fact, I even heard an esteemed gentleman at one of the major investment firms talking about the latest amount of money that's being dumped in, from the from the whole COVID response thing. And his statement was, well, there's so much money coming in that people are going to buy bonds with it as well. So you're seeing, you would think that, that much potential inflation would scare away bond buyers, but, there's so much money around to chase a relatively fixed amount of assets that we are seeing some Goldilocks scenarios right now.
Yeah, well, in fact, in one of the charts of the week is a review, is a chart of the excess reserves on the Federal Reserve's balance sheet. And, with all the stimulus payments that are accruing to individual and ultimately to institutional investors, and they're parking it at the Fed, there's just a tremendous amount of liquidity. In the Goldilocks moment, when you think about, the drivers behind that, I mean, we've got the excess savings, we've got this huge deficit spending. We know that we've got more quantitative easing. The Fed's not going to let up on the gas at all. And then, the potential for an infrastructure bill and obviously what's going on with the pandemic and the vaccine rollout and whatnot. So I think all in all, we've come out of this, much better than expected. And then I do want to just amplify your point on the value versus growth. That last week, when you look at the pure growth index, just last week alone, it was up about 3.2%, where the pure value was only up 0.4%. And then So if you kind of back that up and look at it over the last month, growth is up 9.2%, and then value is up 2.1 or 2.2%. So, we have had that regime change just at a point where people are starting to get comfortable with this cyclical trade. I do think it's, there's a bit of maybe some interim convulsing going on as we kind of get our footing in all of this. I think it's, I think there's a kind of a clear understanding that, that the economy is improving, and, the data is great, right? You've been looking at the data as well. And
absolutely. All the surprises are all positive in strength, across the board. Now, one thing that we did see, and I call it positive in terms of strength, but the producer price index came out last week, and that was kind of an eye opener, and it didn't affect bonds at all, which was really very interesting because the headline rate was over 4%. Now, for many years, there's been really, since inflation's had difficulty going all the way back to the great financial crisis in 08, 09, that corporations have been eating a lot of the producer price index increases. And so it hasn't found its way to the consumer. That's directly in contrast to the kind of inflation that a lot of us remember, going back to the 70s and early 80s, which, all of the policymakers want to avoid for sure. But, that's, if you get a sustained producer price push, from things like the commodity price increases that we've been seeing, and some of the old school parts of the economy that are really working, like construction and real estate and all the home building and all of the ancillary businesses that go into home building, the appliances and various services.
Yeah, well, and we got two charts in particular. You mentioned the commodity basket, but corn prices are really accelerating right now, and then lumber is over $1,000 a board foot, which is just insane. And talking to a builder here recently, it's a challenge. It's a minority part or component of their cost basket, but it's going up at such a rapid clip that actually sourcing is becoming a bit of a problem. But we've seen steel prices move higher. And I think it's a poignant statistic, and I think where we sit right now is in that real uneasy spot that it's clearly transmitting through the production channel, and amidst notwithstanding all of the supply chain constraints that we face right now. I know you've been doing a lot of reading on that, but you do have to believe at some point push is going to come to shove, and the margin, the ability for producers to absorb margin is going to eventually lead to them passing on some of that to consumers. And I think that expectation is there, and had pushed interest rates higher. Now the Fed comes out and says, well, we believe that this is transitory, right? And you get the supply chain issues worked out, and that inherently should increase productivity, which should implicitly or empirically put a damper on inflation. So, the feeling by the Fed, at least in some of the things that are coming out from Fed governors, is that you're going to have a rise in inflation, and then it's going to stall out and kind of crest and roll over. And I'm not quite sure how that plays out, but that we're just going to have to wait and see.
One thing I would just to go back to lumber prices for a second, just to put some numbers on that for our listeners. Once the and it's really hard to overstate how much damage the great financial crisis did to home building. We were building about 2.4 million homes a year in 2007, and went to 400,000 by 2009. And so in the more than a decade plus since the end of the great financial crisis, we've seen lumber prices per thousand board foot as low as $150 to as high as $500. So when you say they're 1,000 now, they're double the highest price since the great financial crisis.
Yeah, so in fact,
that's material.
Yeah, they're literally double from 6 months ago.
Yeah,
and,
which was already a high. So
right.
that is going to start to bite. We've had, and it's interesting. I'm pulling up as we speak on. We've had a couple of kind of weirdly weak home building stats that I think were related to the Great Freeze in February. So, we don't know if these kinds of things like lumber prices are affecting, but, we did have a weak February number for home building, and, we'll see what the March numbers look like. I think that stuff comes out next week. Housing starts comes out Friday, actually.
Mm-hmm.
So that's coming off of, we had a week or a month that the previous month, everybody just said, well, the freeze, it's a one-off. So we'll see, but
we'll definitely see.
It definitely took a hit, and it wasn't just the housing starts. It was existing home sales, the housing indexes, of which there are a few. So across the board, it was kind of tough, and we'll see if that bounces back, or whether, because if we do get another weak month, then you could certainly make the argument that things like higher copper prices and higher lumber prices are really having an effect.
Well, it's all coming amidst the backdrop of a lot of encouraging news, as we've been talking about. Just some more anecdotal data points. The Institute for Supply Management's manufacturing survey was a 37-year high in March, and so when you think about the market, the equity markets, it tends to kind of move in lockstep with that ISM number. So even though manufacturing is a minority component of overall, economic growth, it is important for a lot of reasons. But obviously we want to see that ISM remain high, because if it rolls over, then the history tells us that we're going to get some type of correction in the equity market. So we certainly want to monitor that. But we've got the International Monetary Fund increased its GDP forecast from like 4.2 to 6.4% for 2021, and we may be on the eve of one of the best economic numbers that we've seen in a long time, and so that's something that obviously is encouraging, from from the standpoint of being an investor, but I think there's enough in here, and there's other data points in here that kind of, there are puts and takes. There's reasons to be optimistic, and there's reasons to be cautious right now. And on the plus side, you've got fiscal and monetary policy that are working together to add a lot of liquidity in the market. We've had, like I said, about a third of the population with at least one dose of the vaccine. And we've got, our jobs number. I think you may have some comments on the employment on the labor market, the most recent data point there. But strong auto sales, and then we're growing at a pretty strong clip, and sentiment seems to be pretty extremely bullish. In fact, there's a data point here. I think the Investors Intelligence Advisors poll was in the most recent reading was almost 61% bullish, and only 16 to 17% were bearish. And that's a huge difference. And readings over 60% on bullishness, and then the spread between bullish and bear, when it exceeds 40%, tend to come around peaks. So that would be one offset. We've got a lot of positive things going, but that's one thing that might be a contrarian indicator. The
certainly is.
Yeah.
I mean, that's,
Go
you
ahead.
always got to pinch yourself at these moments where the future's so bright, you got to wear shades. And but yeah, the employment situation, that the jobs number was a blowout that was reported the week before last. Really, and not only was it higher, much higher than expected, but they revised upward previous periods, and so there was a lot more working going on. So it was, and then the motor vehicle sales you mentioned. I mean, we had a 17.7 million annual pace for March, and that's right where that's typically about the peak for the replacement market in North America. So
that's evidence of a really strong market, although it'll be interesting to see with the semiconductor shortages, if that's going to be able to continue because of just the inability to produce vehicles. I know Ford has idled some truck plants, or at least one major truck plant, and I know other manufacturers are worried about that. And an interesting development is we've seen used car prices go through the roof.
Exactly. Yeah, and you can't overstate the importance of Ford, and I think GM also idled some truck plants. I think most of our listeners know, but it's worth repeating. Ford makes all of its money in trucks. Period. I mean, the trucks subsidize everything else, and so when you are idling your main profit center, that's a bad thing. That tells you that this chip shortage is really biting, and it's biting hard. And some of these things, we've talked about the port situation, that was well before what we saw in the Suez Canal, but we're seeing backlogs at the ports. They're setting records at both Long Beach, and then I saw a headline earlier last week that South Carolina's port set a record in March. So both coasts, we're seeing with the chips shortage, the port cloggings. These are the kinds of things that you see at inflections, or maybe not inflections, but at peaks, in the market, in the economic cycle. And so, got to tread carefully here, because it could be a sign, if these things get resolved, there's no reason why we can't move to a higher plateau. But some of these things, And I think this may surprise a number of listeners, but again, we're talking about strength and how strong the economy really is, and that these are signs of maybe an economy that's overheating. And you've got this COVID stimulus bill that was just passed that doesn't plug directly in, very little of that, outside of the checks that were cut. There's not that much that went immediately into the system, but it did bolster budgets across states, localities, various federal agencies. So, that'll be trickling in as a backdrop to an already strong economy.
I think that's the real, risk to this notion that seems to be pervasive among scholars now, is that we'll have this transitory inflation because demand has picked up a lot faster than the supply chain can support. And then, obviously we've had some disruptions, but when we hit the pandemic, it felt like, okay, well, this is going to be a systemic issue that we're going to be dealing with for a while, but everybody was surprised at how quickly it came back. And, it's just, you go from almost a supply side issue to a demand, or vice versa to a supply issue where you can't produce, product. But I guess, looking down the road, it will, with all of the liquidity on the sidelines, all the savings that are built up in the system, the consumer balance sheets that are really healthy. I mean, the U.S. consumer is really the bell cow of the world economy when you think about it, given the weight that we throw around in the global economy. And so if there's an optimism, if there's this kind of consumer jailbreak, so to speak, when we do get herd immunity, that there seems to be a fair amount of pent up demand out there, and I've been noticing too some of the leverage is building up in the system too. I know you monitor retail spending, and that was real strong on a same store sale basis. I might ask you to talk about that, but so it's almost like we become like stuck on this drug, so to speak, that we've got. If you look at consumer spending, that's been really buoyed by stimulus payments, right? Even though we've got great overall household balance sheets, and household debt as a percent of net worth, is down significantly on a very secular basis. But I noticed that the consumer credit report last week showed basically almost a $28 billion boom.
It's huge.
It's the largest 1 month increase in credit since 2017. And this comes while we have like $2 trillion of loans that are stuck in forbearance, right? And so, so that means that basically some 50, 60 million borrowers that were missing, 70, at least the same amount of money on debt payments by the end of the first quarter. And so other things that kind of tell you that there's leverage that's built up in the system, that we've got, 1 in 10 subprime car buyers is now 60 plus days delinquent. Margin debt, in our business, is up pretty high, up 50% year over year. And then we've got global debt to GDP ratios overall that are punching right through the old World War II peaks. So,
yeah. I just add that consumer finance number, the 27.6 billion, that was against a consensus from the street for a 5 billion increase. So the number came in 5x, what the consensus build was. So that was a really remarkable number to show, some of the strength. I was just going to, kind of turn maybe a little bit towards, we had been talking in the last couple of years now, since the administrations have changed, but, that there was some idea that we'd have with onshoring and concerns about the reliability of China as a manufacturing partner, that we have been seeing some strength in manufacturing in this country as a result of onshoring, but certainly the things that we've been seeing with the shipping rates and these shipping, the port tie-ups, the backlog at Los Angeles is not only 6 months old, but a report that I read last week said that it's still growing. It's the worst that it's been, even though that it's been lasting for 6 months. And so to the extent that we have these extended supply chains, it's costing much more in a post Suez crisis world and in a constrained shipping world. Shipping rates are through the roof, and transit times are also likewise skyrocketing. So it's a compelling reason to maybe think about shortening your supply chain or onshoring, which makes the whole idea that we're going to consider raising corporate tax rates, to me, kind of a non-starter. But we've got maybe a golden opportunity to recapture some supply chain action, and I'm not sure we're going to do that if they ram through a corporate tax increase this year.
Yeah, it's a very valid point. Some other things that came up in the news flow and the data last week. We're on the eve of the first quarter earnings releases for all the S&P 500 companies. So right now, profits are expected to increase about 24% year over year. We know that we've had a really big move. This is basically the best growth rate that we've seen since, for probably, at least a couple of years. And they've already been going up as we've been going through the quarters. This optimism is built from within. And so, and also we've seen some tremendous money flows. I mean, almost the stuff, that's made of legend. I mean, that we saw, we've been watching a lot of money go into the bond funds. We've seen actually some relative disintermediation out of the equity markets, but in the span of, basically from, call it 10, 11 years, maybe we had like, 450, 500 billion go into equity funds. We had almost 600 billion move in just basically since November. We've had, again, attributed to a lot of the liquidity that's sloshing around and interest levels, and people, the fear of missing out, not wanting to miss the train as it's pulling out of the station. So, and it's bidding up valuations. And good news is that we've had earnings that are moving faster than the equity market is, and so we've actually seen a drop in the equity multiple from where we were at the end of last year, which is like almost 23%. Even though the market has kind of glided up a little bit, we've had such a strong updraft in earnings estimates that now that multiple is about 20 times. So we're not as expensive we're probably basically about 10 to 12 to 14%-ish below peak valuations that we saw last December. So, and then we've seen a tremendous participation in the amount of positive returns of members of the index, right? Obviously, last summer we saw, basically 5 stocks account for all of the increase in the market, and then you had, the rest that were really lagging behind. But now we have much greater participation, even with this kind of, struggle in the leadership of the market between growth and value and cyclical and technology. So I thought that was a very interesting observation, that in a relative sense, we're not nearly as expensive as we were just at the end of last year, even as the market continues to go up.
Yeah, multiples are always highest, because if the E is depressed, if you're in a recession, you'll have a high multiple. So, if you just think about it, Q1 of 2020, about 3 weeks of March. So really, somewhere about 25% of the first quarter was a zero. Because, when we locked down initially, it locked down really hard. And then all of April, and by the end of April of 2020, you started seeing Georgia and some other states that started to moderate. Texas started to moderate in early May. So these first quarter comparisons are going to be really easy, and so you are going to see some huge growth numbers, especially as it seems like things are as strong as all of the reports have been all through Q1.
Well, the other dynamic that we see, and we touched on it earlier, was the labor report. So, I mean, we could have a tremendous surge in employment, and we've already seen it. There's a chart I have in Charts of the Week that labor employment in that, in the hospitality, leisure, and entertainment sectors, which are, again, like 10, 12% of the economy, but have been so devastated. You're beginning to see those upticks on a sequential basis for hiring, which is really good. And so, notwithstanding just that, but the overall improvement in the economy, could drive a really strong jobs report next month. And I think that will provide yet another shot in the arm for the market, just confidence that we're emerging from this. And again, I think the market has largely kind of plowed through this notion of inflation. Of course, we had such an abnormally low inflation number last year that we're going to be dealing with the base effects of year over year comparisons. But when you get past that, I mean, the market has largely kind of plowed through it. I think for every data point, like I mentioned, the optimism versus bullish bearish spread, for every data point like that kind of makes you think that that hit the pause button. There's another data point that kind of gives you optimism that things are going to continue. And obviously the market is building and analysts are building estimates much higher. So their optimism is being priced into the market as we go. And, usually these types of environments don't end, because of old age. Or a slow death. They end because of some kind of a mistake, policy wise, or in the case like we referred to before, like a taper tantrum. If the Fed decides to taper sooner rather than later, because the market clearly doesn't expect it for quite some time, and they certainly don't expect interest rates to rise until not only do we have the full employment and stable prices, but also better employment within the socioeconomic layers, which the Fed is really focusing on right now. So that could very well be, take years, take at least 18 to 24 months. What do you think?
Well, I just was thinking of Jay Powell, and he was on 60 Minutes last night. I didn't watch the segment, but I've read a lot about what he talked about.
Yeah.
I think it's fascinating to me because if you think about he's still not been there super long. And I think about, when he first came in, it seemed like he had this, here's my playbook. I'm going to be raising rates a quarter of a point every other meeting, and we're going to normalize this rate schedule. And everybody, a lot of market participants were starting to push back on that. And then finally, we had that horrible Christmas of 2019, or no, 2018, I guess it was.
Yeah, 2019 was
just terrible Christmas. He raised rates at the last meeting of the year. I think it was like mid-December, about December the 11th or something like that. Just crushed the market. And compare that Jay Powell to the Jay Powell that we've got now, that is just saying, hey, I see no rate increases for a long time. Even as you and I talk about some of these inflationary impulses that we are seeing. And even, you can look at petroleum prices. That's an inflationary pulse. You look at gasoline prices and how much they've increased since the election. So there's round and about a fair amount of inflation that people are that I think can affect the system, but yet the Fed on the one hand and then fiscal policy on the other is got the taps wide open. And just even thinking about how they shovel out the money from that, the $1.9 trillion COVID relief bill that was passed last month, that is just, as I alluded to earlier, it's just going to take probably the rest of this year before all of that gets spent. So it wasn't just a one-time stimulus. It's going to be a sustained stimulus, and that's going to be running alongside of infrastructure if they do it, which they probably will do something, and the Fed. So, I still, as a fundamental guy, I think at some point you mix all of this together, it's got to get inflationary. We're just not seeing it yet. Seeing some at the producer level, but not trickling down to the consumer.
Yeah, I mean, I do think we're in for a regime of higher inflation, but it's for the right reasons. We've just been saddled with abnormally low inflation for such a long period of time. I know just a data point that the United Nations has a global food index, and it's up for the 10th straight month. This is global, right? So it's not just U.S., but it's the largest increase that they've seen in 12 years. And and that's you mentioned energy prices, and it does have an impact, even though a lot of people focus on the core, which excludes food and energy, but it does in the sense that petroleum is an input cost into plastics, which is an input cost into consumer goods and things like that. And if it's sustained, you could have that transition and that transmission, I guess would be a better word for it. But I think there's room, again, not dwelling on this Goldilocks thinking, that if you can mitigate and not have this outsized unexpected inflation, that it's measured and reasonable and observable, right? That you can have a market that is conducive, that's favorable, albeit with pockets of volatility. I think we're probably due for one now, but that's healthy. I mean, we've got some data and charts of the week that show you that I mean, a 5% correction is something that you should that you could easily expect more than once a year. And we haven't seen it in a little while. October was a little bit disruptive, but I think we could certainly see that. But the equity market could still continue to move higher despite these things, right? And
we've had it. If you look at when we were talking about growth versus value, if you look at we had a 10% correction in the NASDAQ composite from mid-February into mid-March.
Yeah,
that was a full 10%er.
It's healthy to differentiate different parts of the market, but you're absolutely right. But it was part of that general rotation.
Exactly, towards value. And so, people didn't notice it as much because, the Dow was on the up as the NASDAQ was down. But, you are seeing, that they're having some of these rolling corrections through, through various sectors of the market, which is also, it's a healthy thing, I think.
Absolutely. Volatility being as low as it is maybe a little disconcerting, not necessarily for investors that like to watch their accounts go up every single day, but from a portfolio manager's perspective, you do like to see a little bit of volatility. So I think it helps to I think set a better balance for identifying pockets of value, and you don't get into bubble environments where we know the amount of institutional trading and program trading that pervades our market, and and high velocity trading, which can create very strong bursts of volatility when it's least anticipated. But I'm very optimistic. You know, everything that we've talked about today tends to portend a positive overall environment. Again, I think we've got some things to reckon with probably in another couple of years, clearly. But I think the circumstances which are in front of us today are in very large part reasonable. And
yeah, I would just mention though, I still think, and again, I think it's healthy that the volatility is not anywhere near what it was a year ago, because
Nope.
you know that was off the charts. But you know, for folks that keep tabs of these things, the Vix Index, we had the Vix Index in 2017. Was actually spent an entire month below 10.
Right.
And you know, right now the VIX is about 17, and that's higher than it's been for most of the last 4 or 5 years. And so that, I think, tells you that there's still a healthy amount of skepticism, if skepticism is volatility, which is fear. And so that helps to keep, I think, keep the blue skies crowd from getting too fair an opinion on things.
Yeah, I think it'd be healthy to see that maybe, you know, somewhere between 20 and 25. You know, maybe 17 is a little bit low for my blood. But you're right, 2017 was kind of like definitely a low point for sure.
It was 9.5.
9.5 is just basically no volatility whatsoever. But well, we could talk about VIX for the entire you know, for the next hour if we wanted to. There's so much to digest and discern in the markets. So appreciate everyone listening to us this afternoon. Hope you've enjoyed the discourse between Tom and myself. We bring different perspectives to it, and you know, I think we'll keep at this for a while and see how everybody likes it. But we welcome your comments and your feedback. Please feel free to reach out to us at our contact information, and look forward to seeing you very soon. Have a safe week and have a wonderful week, and we'll talk to you again soon.